Welcome back to Power Lunch. I'm Seema Modi. Chinese stocks already hit by regulatory headwinds are lower again today, this time having to grapple with the prospect of an economic slowdown in the country. Industrial output and retail sales for July both increasing, but at a weaker pace than expected. Let's break it down with your Trading Nation team, Ari Wald of Oppenheimer and Michael Binger of Gradient Investments. And Michael, in the face of heightened regulation, China was able to cheer its strong growth story. But this latest data that we got overnight suggests otherwise. Curious if you'd be a buyer of any of these names on continued weakness.
Yeah, the latest data points out of China did show some slowing. I mean, for example, industrial output was roughly 6%, where in July, where it was 8% in June. I think the COVID outbreaks there are putting a little bit of a pause on the economic recovery. You throw on top of that the regulatory atmosphere in China targeting sectors and companies. The headwinds are real in China right now, but some stocks I think have been, thrown out with the bathwater here. And one of those I think is Baidu. I think Baidu is a buy right here. The stock is down 50%. It's outside of the scope of regulatory impacts right now. I think it's akin to a Google in the U.S. here, driven by search engine, but a lot of shots on goal with AI technology, cloud, autonomous driving, their semi-chip business. Sales growth last quarter was over 20%, mid to high teens growth for the next 3 years. I really think Baidu, if you're going to pick a stock or a sector in China right now, Baidu is the one to buy.
Ari, there's also the contrarian take that a slowdown in China's economy will actually push the Chinese not to implement such strong regulation. What's your hot take? Do you think it's time to dip in here?
I would file China in the too late to sell, but too early to buy category. With that said, just given the broken trends, though, it is an area we would still prefer to sell on strength rather than buy on weakness. And if you were to look at the iShares large cap China ETF, its ticker FXI, it was turned lower recently from 48 to at $50 resistance. That's been the upper end of its range for much of the last decade. Currently trading at about $40, but if you can see from the chart, $33 has been the hold your nose and buy level, more or less, over that 10-year period. Also shown relative to the S&P 500 in the bottom, that ongoing underperformance indicates to us that the better opportunities are here domestically.
I hear you. Key levels to watch there. Ari and Michael, great to see you both. Thank you. And for more Trading Nation, head to our website or follow us on Twitter.
There's a classic investment thesis called the Dow theory. It says that transportation stocks can either confirm or deny a broader market trend. But it's important to remember that transports can be sensitive to changes in oil prices and other market influences. So don't rely exclusively on this theory when making an investment decision. I'm Randy Frederick, and Schwab is the better place for traders.